Hello everyone, in this video I want to talk about why I want to sell Amazon and why I want to sell Google, why I want to move away from the hyperscalers, from the Magnificent Seven companies, from the big tech, and what I will do with my cash. So I have plenty of things to show you in this video. I will show you my portfolio, what I have sold, what I have bought. I will show you some specific Twitter posts, and I will show you the mathematical thesis behind it, some formulas to really explain my point, why I want to sell these big Capex spenders. It will be pretty interesting and you will understand why I want to move away from tech and why I want to invest more massively in capital light businesses, especially in the current AI environment. I think it will be pretty interesting for you. I think it will be a long masterclass on capital allocation. So yeah, let's start. In case this is your first video from this channel, welcome. My name is Christophe Noor. I'm French. I've been investing in the stock market for almost a decade now and have achieved a performance of 25% per year. And I've been following the big tech for a while. I first bought my Facebook shares back in the days. It was called Facebook in 2018. I bought Google in 2018. And I bought Amazon, I don't know, in 2024, something like this. So yeah, I've been following big tech for a while and I've been an investor for a while. So I know what is happening over there, what are their Capex spending projects, etc. And very recently, I sold Amazon. In the past, Amazon was 10% of my portfolio. Now I completely sold out of Amazon. And for Google, the position has grown so much, it had become 15% of my portfolio. And I trimmed it, I sold 1/3 of the position, and now it's 10% of my portfolio. So what is remaining right now is Google 10%, Meta 10%. So the hyperscalers allocation for my portfolio went from 30% or even 35% if you include Google ramp up to 20%. And maybe in the future, I will continue to trim. The first one I will trim is Google. I prefer Facebook, I think it's cheaper. But I want to continue trimming Google. As the price is getting higher and higher and higher, I think the risk reward is not very appealing. And I want to start this video by showing you this great Twitter post from the Capex letter. Big tech is sacrificing buybacks for AI Capex. Combined buybacks by Amazon, Google, Microsoft, Meta, and Oracle plunged to $12 billion in the fourth quarter of 2025, the lowest since 2018. Share repurchases have declined 70% since the $50 billion peak seen in 2021. Amazon has not bought back a single stock since 2022, redirecting capital into AI infrastructure. They are putting this cash to do more Capex. Meta slashed buybacks to a combined $3 billion in Q3 and Q4 2025, down from $30 billion in 2021. In the past, Meta Platforms was cheap. In the past, Meta Platforms used a lot of cash flows to do buybacks. Now they are no longer doing this. All the cash they have is allocated to do Capex. This is a new trend. You did not have this before. At the same time, Google cut buybacks to $17 billion, nearly half the $30 billion spent in the same period in 2024. Same process by Google. In the past, they did a lot of buybacks because the stock was cheap. Now the stock is no longer cheap and all the cash is used to fund Capex. Capex is all that matters. So you have a beautiful chart here to show you the evolution of buybacks in dollars term, in billions of dollars, from 2016. You see that from 2018, the buyback sums improved significantly. In 2020, 2021, these were the kings of the world. So obviously you have excess cash and they did a lot of buybacks. And then it is trending down, stabilizing. And in 2025, almost no buybacks. And in 2026, you will have almost no buybacks. I'm strongly forecasting you will have lower buybacks in 2026, compared to 2025, okay? And because of this big Capex spend, here is what you have. This is a great chart from August Erkan here. This is why Google and Amazon got hammered after announcing significantly higher Capex than expected. Hyperscalers' free cash flow has declined by 60% since 2024. This increases pressure to see solid returns from AI investments, which we aren't seeing right now. So, in this chart, you can see the free cash flow of Oracle, Meta, Google, Amazon, and Microsoft since 2016. You can see that this trend is, roughly speaking, up and to the right. You have Amazon in green that is very cyclical. It's up and down, up and down. Amazon is famous for doing this. But for the other companies, they are famous for being free cash flow positive. So as you can see here, Microsoft in gray, in black. You can see Google here, massive amount of free cash flow. Meta in red, massive amount of free cash flow and growing. And Oracle, same thing. What can you see? You can see two things in this chart. That the free cash flow declined in 2022 when you had a small recession and at the same time a little bit higher capex. And then when the world resumed, you had more free cash flow, time was good. Since AI, since late 2022, big tech decided that it was the next revolution, industrial revolution, which is true. They decided that it was the next leg of innovation, growth opportunities, which is true. So they decided to slow down on the buybacks and use all the cash to fund Capex. And because you use all your cash to fund Capex, your free cash flow is dropping like a rock. We went from what? $250 billion at the peak to now $50 billion. And it will decline because Amazon just announced $200 billion of Capex for 2026, more than Wall Street expected. Meta Platforms announced roughly $120 billion of Capex for 2026, more than what Wall Street expected. So they expect almost zero free cash flow. Google announced $180 billion of Capex, so they announced almost zero free cash flow. All the tech companies are using literally all their cash flows to fund Capex. And I have questions. I'm not telling it's bad. I'm not saying it's bad. I'm saying it adds a layer of uncertainty that I don't like, because my investment strategy is to focus on companies that are increasing free cash flow per share by 20% per year. If you have massive capex spending, you will maybe not have 20% free cash flow per share growth. So what is the point here? And I have the mathematical formula to show you now. Okay. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. So everybody understands my point very well. Here is what I have. The AI capex trap, why I'm pivoting away from big tech. I did some analysis on Gemini, and this is my article written with Gemini. So I had some formulas, I had some examples, and Gemini was kind enough to summarize everything. Here is what we have. Where do I put my face? Put my face here. Perfect. The investment thesis for the big giants has fundamentally changed. For Meta and Google, it used to be a high margin software and massive buybacks. For Amazon, the value was in a massive scale and relentless operating efficiency. In the past few years, we learned that Amazon was going after AWS and advertising, so segments with better margins. So the story was very simple. For Meta Platforms, it's a social media app, so they will just grow number of users, do more buybacks, have more margins. For Google, beautiful margins, a beautiful cash fortress, very simple to understand. For Amazon, they wanted to grow into more asset-light business models like Amazon, AWS, like advertising, third-party resellers, and it was working correctly. More efficiency, better margins. but the AI revolution has turned them all into asset-heavy infrastructure companies. So, as a quick reminder, in case you don't know me and you discover my YouTube channel, I've been investing for almost a decade. I have generated 25% per year because I have always focused on companies that are growing free cash flow per share. This is the only one metric I monitor, okay? Number one metric. And I invest for a 20% free cash flow per share growth. And all the companies I have in my portfolio, I am invested because I think they can grow their free cash flow per share at 20% per year for the long term, for the next 3 years, 5 years, 10 years. And the math says that target is now under extreme threat with Meta, with Google, with Amazon, and I will show you why. So, part number one, the original equation. I want to make 25% per year, 20% per year, so I want my free cash flow per share to grow at 20%. Please remember the per share, it's quite important. My investment goal is simple. I want companies that grow free cash flow per share by 20% annually for the next 5 to 10 years. Here is the formula. It's very simple. I have a simple investment process and it works. You want to grow your free cash flow per share. So you talk about your free cash flow. The definition of the free cash flow is cash flow from operations, CFO, minus the Capex. You divide everything by the total shares outstanding. So you can manipulate these three metrics to grow your free cash flow per share. One, you have three levers. One, you increase the cash flow from operations. So you either grow revenue or you improve your margins, your free cash flow margins. This is the first one. You can also decrease the Capex, keep the spending low, okay? Or you can decrease the shares with buybacks. This is why the majority of my holdings in my portfolio have buybacks. The majority of my holdings in my portfolio are growing, okay? You now understand the philosophy, the mathematical formula behind this portfolio I have right now. By the way, my portfolio is public. You can go to eToro, type my name on the internet and find my portfolio. This is public on a daily basis. Anyone can check my portfolio, what I'm buying, what I'm selling, okay? Let's go back here. Historically, Meta and Google did all three. They were growing, they kept the spending low, or rather low, compared to other industries, and they were doing buybacks, especially since COVID, 2020, 2021, better margins, better growth, and buybacks. Amazon focused on lever number one to eventually fund its own version of cash flow. Amazon was only growing, so only growing the cash flow from operations. Now, for these three companies, they are all doing the opposite of lever two. They are all increasing the Capex immensely, and of course, it is impacting the formula. Part number two, the AI shift, the math of the pivot. Let's look at an hypothetical tech giant company to see how Capex destroys your growth, because maybe that's not clear for you. For most people, that's not clear actually. You can see on Twitter, on YouTube, people don't know how to think about this Capex. Is this a big deal? Is this temporary? How will it affect the cash flows? How is the cash reinvested in the business? People don't really know. So let's use a hypothetical example. Let's say on year zero, the operating cash flows are at $100 billion and the Capex is $20 billion. So the free cash flow is 100 minus 20. That's $80 billion of free cash flow. To grow free cash flow by 20%, you need the free cash flow to grow at $96 billion. So in theory, fair enough, you can do it. Now, here is what happens in real life. The AI reality. To win the AI race, they doubled the Capex to $40 billion in my hypothetical example. Even if the business grows and the cash flows from operations hit $150 billion, so that's a healthy 15% growth after all. I mean, even if the business is growing in a nice way, 15% per year, the new free cash flow is $150 billion minus $40 billion because you just doubled your Capex. So that amounts to $75 billion. The result, despite 15% operational growth, free cash flow per share has actually shrunk by 6%. Buybacks often stop because the cash is now buried in data centers rather than returning to you. Exactly what my 2 Twitter posts showed you. The free cash flow is declining, so the buybacks are declining. They are using all their cash to fund buybacks. Now let's look at the real numbers for 2026. To reach my 20% free cash flow growth target in 2026, these companies need to grow revenue at levels that seem mathematically impossible. Now this is where I've seen no one talk about this on Twitter or on YouTube. Let's talk about Meta. Meta has a guidance for Capex at $120 billion. The math, to grow free cash flow by 20%, Meta needs to generate a cash flow from operations of roughly $140 billion. So, if you assume the margins, the free cash flow margins, the operating cash flows margins will stay the same, Meta needs to grow revenue by $134 billion in a single year. That is roughly 65% revenue growth. And now Meta is guiding for what? Meta is guiding for a revenue growth rate of 30%. So to reach my investment goal to grow free cash flow per share at 20% per year, Meta doesn't need to grow to 30% per year. It's not enough. Meta Platforms actually needs to grow revenue by 60%. And they will not do it in 2026. So it disqualifies Meta Platforms from my investment universe. Now there is a big question. Maybe this year the goal will not be met, but what about next year in 2027? What about after this, 2028? That's a very good question, and I will talk about this later. Second example, Google. The Capex guidance for Google for 2026 is $180 billion. The math, to hit my 20% free cash flow growth target, Google needs a cash flow from operations of $226 billion. So given stable margins, Google needs $300 billion in new revenue. That is a 75% growth required to offset the Capex hike. I don't think Google will grow by 75% in 2026. So it disqualifies Google from my investment universe. You see the impact of Capex now. You see how big the requirements are. You see how big the question mark is. This is the kind of questions I have with my portfolio and the reasons why I am selling these stocks. 3, Amazon. Amazon has a Capex plan of $200 billion for 2026. To simply keep free cash flow stable while spending $200 billion of Capex, Amazon needs a cash flow from operation of $200 billion at a 20% operating cash flow margin. Amazon needs to find $340 billion in new revenue. Amazon is a beast. It's currently growing at 14%, and not 50%. It needs to grow immensely to offset the Capex growth. So, I want to draw, and I want to show you my objective. 20% free cash flow per share growth. This is my objective after all. And here is our starting point. This is the situation I was in 2018. You invest in companies and your objective is here, 20% free cash flow per share growth. In 2018, when I bought Meta Platforms and Google, these companies were very safe, net cash, producing a very good amount of free cash flow. In 2020, 2021, these businesses reaccelerated. So life was good. Life was reaccelerating. It was beautiful. And then here we are. Now we are in this situation. Let me do part two. Now the free cash flow. This is the line of the free cash flow. The free cash flow is dropping because they will reinvest everything. And let's assume for this year, which is the case, that free cash flow will be almost zero for 2026. It is the case. I am not creating numbers. They guide for almost zero free cash flow. So let's go back to back level. This. Now there is a big question. In theory, the free cash flow will stay at zero and then the business will reaccelerate and the revenue growth will skyrocket, and then the free cash flow will increase and increase and increase and increase, and we will finally reach our 20% free cash flow per share growth. This is what can happen in theory. Now I have a couple of questions. This is your revenue in R going up. Revenue reaccelerating that will offset the cost of Capex. In red here, this is your Capex. Capex cycle. Question number 1, how long is the Capex cycle? Okay? Is the Capex cycle with zero free cash flow 1 year? It's only 2026, and then after 2026, the Capex will the free cash flow will rebound? Is it 2 years? Is it 3 years? Up to you. This is a question that has no real answer, and even Mark Zuckerberg, Sundar Pichai, they don't know. They are spending ungodly amounts of dollars to fund Nvidia and AMD. They are doing everything they can to invest more in their own chips, Trainium, etc., to not rely on Nvidia, but the results are the same. They are investing billions and billions of dollars in Capex, and the free cash flow right now is almost zero. And I invested in Meta, in Google, in Amazon to reach 20% free cash flow per share growth. You can totally remove the per share from the equation because none of these three companies will do buybacks now. It's not a priority at all, as I just showed you before. So buybacks, I'm out. What about the free cash flow? It's a very good question. How long is this cycle? Let's continue. Because you have additional risks. Now they invest a lot in Capex. You know how Capex works, maybe you don't. I have a master's degree in accounting, so I can spot the shenanigans, how companies can manipulate D&A, depreciation, amortization. You change the lifetime value of a chip or a data center, and you can kind of manipulate your earnings. For most of the time, it's okay, it's fine, because everybody is doing it, including the Magnificent Seven companies during COVID, and nobody cared. But now the Capex is so big that maybe you can't hide it anymore. You can't handle the truth. So the big risk, the margin compression. For all our three scenarios, we assumed stable margins. Stable margins, stable margins, stable margins. If there is a margin compression, it's a problem. These calculations assume stable margins, but that is unlikely because of two hidden killers. One, depreciation and amortization. Massive Capex today becomes a massive non-cash expense tomorrow. This will crush GAAP, so real net income, as the hardware gets older. As you have more Capex, you have more expenses every year. Two, the cost of debt. These companies are starting to borrow billions to fund these data centers. Interest payments will eat directly into your cash flow. How can I show you this? I can show you on Guru Focus that in the past, Meta Platforms was a company known for having a fortress of cash. As you can see here, in 2018, zero debt, $40 billion of cash. In red, that's the debt. In green, that's the cash. What can you spot? You can see that for this chart here, the green line is growing, but the red line is growing massively more. The company is no longer net cash. The company is just borrowing more and more and more to fund this Capex. The same thing is true for Google. In the past, Google had zero debt, and to fund this Capex in excess of free cash flow, they borrow more. In the past, look at 2018, zero debt, and the company was filled with cash, $100 billion of cash. And now they are taking more debt and more debt. It is increasing. So now it's okay. Now this is manageable. They can pay off their debt. They are not net debt. It's fine. What about in the future? If the Capex cycle, as I showed you here, continues for 1 year, 2 years, 3 years, what if AI is much bigger than anyone thinks? What if the Capex spending is 3 years long? It means they will take on massive amount of debt. The free cash flow will be zero for 3 years in a row. The revenue will increase, yes, but the free cash flow will be zero. So zero buybacks, and I'm not reaching my goal of 20% free cash flow per share growth. Okay, now I know that some of these companies are accelerating top line. For example, Meta Platforms, out of all the Magnificent Seven companies, they have the best reinvestment opportunities because they are growing much more and they are guiding for 30% growth rate. You have better monetization, better ad impressions, better ad targeting, better ad prices. So the Capex is worth it for the moment from the point of view of a business. The revenue is reaccelerating, so life is good. For Google, maybe you saw this in the timeline, but the Google Cloud segment is reaccelerating at 40% per year, 45% per year. The Google is reaccelerating. And for Amazon, AWS is growing 20-25% per year. The advertising segment is safe. So for the moment, you kind of see signs of reacceleration. Everyone agrees on this. My question is the revenue reacceleration going to offset the Capex reacceleration? It's all about this ratio between the growth in red and the growth in green. Which one will be superior? If revenue growth is higher than Capex growth, we are safe. If it is not superior, or it's the same or inferior, it's a massive red flag for my investment thesis. And this is a risk. This is a risk to grow, to reach my goal. Free cash flow per share will have to grow 20% per year. And I am not sure of this relationship. I am not sure if the revenue growth will offset the Capex growth. I am not sure of the cycle for Capex. 1 year, 2 years, 3 years. What about 5 years? What if it lasts for long? I'm not sure it will last 5 years, to be honest. I think they will become more efficient and pivot and become more efficient and use less Capex. But what if, okay? Let's say for the best case scenario, it lasts 3 years. You can see the charts for Capex. This is just unbelievable. Let me continue. The balance sheet transition from safe to risky. Historically, Meta and Google had super safe balance sheets. When I invested in them in 2018, they were super safe. Now, they were net cash kings, sitting on a mountain of cash with zero risk. And if they continue the level of spending in the coming years, which they are doing right now, they will be forced to take on massive amount of debt. And they are starting to do this. We are moving from a world of fortress balance sheets to a world of high leverage infrastructure bets. You can see what is happening with Oracle. That is a risk, guys. That is an issue, a massive risk. And when we enter a recession, they will pay a very high price. This drastically increases the risk profile of the investment. Now, I want to go through 7 reasons why all these uncertainties are breaking my model. 1, I told you that before, unknown cycle duration. We don't know. Nobody knows. You don't know. I don't know. Mark Zuckerberg doesn't know. Nobody knows if this is a 2-year burst of Capex or a permanent 10-year increase in capital intensity. Nobody knows. Literally, AI is moving so fast, nobody knows what the Capex will look like in the next 2 years. 2, the offset lag. It takes years for a GPU cluster to generate enough revenue to pay for itself. We are entering a dark period where cash disappears before it returns. Exactly this. We are in this valley. For Meta Platforms, they are kind of reaccelerating, so we can see the light at the end of the tunnel, maybe, but still, it's 0% free cash flow. So maybe you can spot some early signs of reacceleration right now, but for the moment, the reacceleration is not enough. The revenue reacceleration is not enough to offset this. I told you the growth rate Meta needs to reach my goal. Meta is guiding for 30% growth rate. They need to grow 65% their revenue to reach my investment criteria. So for the moment, I am seeing early signs, but it's a no. It's a no. It's not a yes. 3, the defensive trap. These companies aren't spending because they see a new prize. They are spending because they have no choice. AI is the new thing. If you don't invest in AI, you will die. Their business models will die and get eaten by competition. If they don't buy the chips, they lose their core business. I prefer investing in opportunity, not survival. They said it on interviews. All the CEOs say it's a new revolution. And I'd rather spend too much than spend too little. I mean, check the recording. Everything is public. Meta Platform says we want to invest like $600 billion. And it's okay if we lose $600 billion. It will not kill us if we invest too much. But it will kill us if we don't move and then everybody moves too fast and we are too slow. It will kill us in terms of efficiency, business model, talent. All the good brains from Meta Platforms will leave for OpenAI and Google. We have to invest. So they are forced to invest more Capex. Yes, we said they are efficient. They want to look at Meta Platforms in 2023. You have the year of efficiency. I'm very well aware of this. I bought the dip when nobody wanted to touch Meta Platforms. I'm very much aware that Meta Platforms is one of the best business models on earth. I'm very well aware that Mark Zuckerberg, for me, is a top 5 CEO of the world. So yes, you have efficiency. But now, despite all the talk about efficiency, they are investing more and more and more and more in Capex. There is no signs of ending this cycle. Actually, this Capex cycle is accelerating right now. 4, valuation breakdown. My valuation system is based on free cash flow. So if free cash flow drops towards zero, these stocks become speculative bets on a distant future. I don't buy hope, I buy cash. My valuation model is based on free cash flow. If you don't produce free cash flow, I can't value the business. So I can't value Meta Platforms anymore. I can't find the intrinsic value of Meta Platforms or Google or Amazon. You have earnings, but you can maybe manipulate earnings too much. So I love free cash flow. And if these businesses are no longer producing free cash flow, they don't fit my investment filters. 5, visibility versus volatility. I prefer the visibility of consistent buybacks and 10% organic growth. AI Capex is the opposite of visibility. You know this too well, I think. AI is moving very fast. You have every day, every week, new models that are shocking the world. All the SaaS investors, all the investors that are invested in software companies know this too well. Everybody is bleeding cash at the moment. AI is moving very fast. So literally nobody has any visibility. And I don't like this. I don't like that the whole industry has zero visibility and the business model and capital allocation decisions have zero visibility. Okay, this is something that I dislike. 6, the obsolescence risk. If a new AI architecture comes out new year, these $200 billion data centers might become obsolete before they're even fully paid off. This is what happened for TPL, Texas Pacific Land, and they had discussions of data center projects. But these new data centers became obsolete in a few quarters. So they postponed the decision to build something. Because imagine you build a huge data center. After 2 years, it's obsolete. You have to build a new one. So it's a massive cost for nothing. So yeah, of course, everything is moving too fast. That's a big uncertainty. And 7, after all, investing is all about opportunity cost. Why take the risk on these heavy spenders when I can buy data monopolies like Moody's, S&P Global, MSCI, FICO? They provide the essential data for AI models without having to build a single $40 billion data center themselves. They get the upside with zero capex increase. Investing is about opportunity costs. You have two kind of companies. One company that is spending a lot in capex to benefit from AI, and one that is spending zero in capex but will still benefit from AI. I'm choosing the latter. I'm choosing the second category of companies that don't have a Capex problem, okay? So now a lot of questions were asked. And I know the kind of comments this video will raise. Some people will say, don't touch Google, it's a winner. I made a video a couple of weeks ago saying I am trimming Google because the valuation is high and I'm seeing better risk-reward opportunities. And I saw the reaction from the market. People are in love with their stocks. And I think that's a huge mistake. You want to be objective, you want to be rational. Google, objectively speaking, has run up massively. So the risk-reward opportunity is no longer the same. And now, as all the software stocks are down, now as all the data providers, companies' stocks are down, I am seeing better risk-reward opportunities. So I already completely sold out of Amazon. I already trimmed Google, and I think I will continue. As these stocks are going up, when it comes to Google or Meta platforms, the risk reward is getting less and less enticing. With that said, the first stock that I would trim is Google again. And it seems like I'm not the only one thinking this. You can look at Dataroma, the 13F, all the legendary investors. You have more and more super investors that are taking profits from Google. They are selling Google because they see exactly the same thing. The stock has run up a lot and you have other opportunities that can be better. Depends on what you like, depends on your circle of competence. But yeah, this big uncertainty when it comes to Capex is preventing me from achieving my goal of free cash flow per share growth of 20%. It all revolves around this equation. You want all your companies, well, I want my companies to grow the free cash flow per share at 20% per year. And the more I look at it, the more I analyze them, Meta, Google, Amazon will maybe not reach these goals. And I'm seeing other opportunities with a better likelihood of reaching this goal. So these are all the reasons why I want to move away from big tech. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn my strategy to generate 25% annual returns. You will learn how to find winning opportunities. You will learn how to properly value any stock, when to buy, when to sell, so that you can build a strong portfolio filled with great companies. Additionally, inside this coaching program, you will have access to an exclusive community of like-minded investors, and also you will have my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need for your email address, just click the link in the description and I'll see you on the other side.